In this video we're going to take on a pretty crucial topic for equity investors, and that is why do stock exchanges exist, what are they for, and how do they impact your investing life. Okay, very simple example. Imagine, if you will, you've got a big block of shares to sell this morning. So maybe you've got 100,000 shares. Now you might say that's an artificially large amount. There are people out there who trade that kind of volume in companies day in, day out. You're thinking, right, I'd like to dump 100,000 shares. How am I going to do it? Now, it might just be you know someone who wants 100,000 shares, in which case I suppose you could go and haggle with them, agree a price, and get on with the trade. And in the financial markets, finding your own counterparty and doing things away from a formal stock exchange, if you like, is known as over-the-counter trading, and it's still perfectly possible. But there are some problems with it. Number one, it's not necessarily the quickest way to do a deal. You may have to spend a little bit of time looking around for your counterparty. Secondly, do you trust them? What happens if you hand over the shares and they don't pay you? And for them, of course, the reverse is true. What if they hand over their cash and you never deliver the shares, or I never deliver the shares? So you've got that kind of risk. You've also got the issue of maybe I'd prefer to do this whole thing anonymously, because it's quite a big trade. I don't want word to get out through whoever this guy is I'm going to sell to that I'm looking to dump 100,000 shares, because if enough people find out, they might actually move the price down against me. So maybe I'd prefer a way of doing it that doesn't sort of reveal my identity. And then there's the issue of the price. Basically, what price am I going to agree to sell these shares for? What do I use as a reference? Do I find out what lots of other people are trading shares for and use that as a reference price for my little trade? Or how do I go about it? Now, a lot of these problems can be solved by a stock exchange. Stock exchanges bring together lots of buyers and sellers, originally in coffee houses, if you're looking at the London market, around London, but later formalised into proper buildings, and of course now with sophisticated IT and all the rest of it. But the principle is very simple. You're basically bringing buyers and sellers together in one central marketplace. If you bring enough of them together, you'll get reliable prices for things like shares. Because you've got lots of people trading, you can reckon that the price being struck at any one point in time is representative for something like, say, a Tesco share. And these days, exchanges, as we'll see in a moment, build in lots of extra features. So, for example, you can trade anonymously if you need to, and you also, as a user of an exchange, get a thing called a central counterparty guarantee, which is a flash way of saying the risk of either the buyer not paying the seller or the seller not delivering the shares, because you think about it, those two things got to happen for a trade to work, is nearly zero. Okay, so lots of reasons for exchanges to exist. How do they impact your life as an investor? Well, let's take a look at that. Okay, so imagine here you are as an investor. My graphics are not fabulous, as anyone who's watched my other videos will know by now, and you're looking to make a share sale. Okay, so who would you call? Well, the answer is you won't ring the London Stock Exchange. These exchanges, there's one in London, one in Tokyo, one in New York, one in most of the major capitals, are like clubs. They have members. Okay, they don't want to let any old sausage in. They want to make sure that only people who will honour trades and are known to them join as members. And to be honest, in a cost-benefit point of view, it doesn't make any sense for a very small trader to become a member. So, who would I phone if I'm looking to sell 50 or 100 or 200 shares this morning? And the answer is a broker. A broker will be a member of the London Stock Exchange, so they can start to get things going for me. So, as Tim Bennett, chances are I'm not going to have anything to do with the London Stock Exchange directly, other than going on a kind of tourist tour of it. What I'm going to do is phone my broker. That's broker, and give a sell instruction. Right. Now, just worth mentioning, brokers tend to be members of these exchanges. So in London, there are lots of brokers around who are members of the London Stock Exchange. Other brokers are members of the New York Stock Exchange, and so on. And my broker, just worth noticing, might offer me one of 2 or 3 levels of service. And that's something I address in another video, how to choose a broker. But it might be that I'm just doing an electronic trade, cheap and cheerful, execution only, in which case I just tap my instruction into a keyboard and it goes straight through to my broker. And my broker, by the way, could be one of the big banks, it could be a slightly more independent broker, a Brewin Dolphin, for example, or a Charles Stanley, all right, but nonetheless, lots of brokers in the market, and in another video I address how to choose one. But my trade could be done electronically. It may be I pick up the phone if I've got a more expensive relationship with my broker, or I'm trying to trade something that's a little less popular than, say, Tesco shares or Vodafone. But anyway, have a look at my other video if you're interested in how to go about picking a broker. But let's say I've got one, I'm happy with whoever that is, and I issue a sell instruction. Now the point is, basically in this introductory video, the broker, either directly or indirectly, will have a relationship with the London Stock Exchange, let's say for UK shares. Now, you don't have to sell UK shares through London Stock Exchange as a broker. There are other exchanges that list UK shares, all right, but the London Stock Exchange enjoys a pretty hefty share of the market. So my broker, he may aggregate my order with quite a few others coming in from clients, because I'm not the only person selling today, especially this popular share, and then pump an order through to the London Stock Exchange. Now, without going into too much detail here, what's the point? What's the role of the London Stock Exchange? Well, of course, what will be happening on the other side, let's say, is lots of investors will be pumping buy orders through their brokers for the same stock. If it's a popular stock like Tesco, Vodafone, so there'll be lots of people like me giving instructions to their broker. The broker will then be pumping orders through to the central marketplace, the London Stock Exchange. So you can imagine a whole load of buys flooding in to this central marketplace. And what is the job of the London Stock Exchange? Well, essentially, it's very straightforward. Sounds straightforward. It's to match trades. So basically, the LSE tries to match as many buy and sell orders together as it can. Now, how do you do that? Just a word about that. If you go to the London Stock Exchange building, you may be disappointed insofar as it's not as exciting as going to the New York Stock Exchange. At the New York Stock Exchange, you'll see lots of people seeming to kind of shout at each other a lot, and a bell rings and it all looks quite exciting. At the London Stock Exchange, it's all very silent. There are not many people around in reception, and frankly, everything seems quite quiet and under control, despite the fact there are millions of trades happening as the day goes on. So what's going on there? How are they doing this? Well, just worth noticing that the London Stock Exchange, an awful lot of trades that are done are matched electronically through what's called an order book. Now, I'm not going to take on the structure and workings of order books in this video, but basically an order book simply says, well, if enough people want to buy Tesco at around £2 and enough people want to sell Tesco at around £2, can't you just use the internet or a computer program to simply match those trades together? Okay, there's no need for a middleman, if you like. However, it is possible on exchanges to still have deals done through what in the London market are known as market makers. Right, now market makers won't thank me for this comparison, but they operate a little bit like second-hand car dealers, if you like. Imagine you're trying as a broker to offload a slightly less popular, less well-known stock, or you've got a particularly big order and you're not sure it's going to clear through this electronic order book. You could approach one of the LSE's market makers. And market makers are a bit like second-hand car dealers. They match trades as well. All right, but they're a little bit more specialist, if you like. In fact, some exchanges call them specialists. So what they'll do is you contact one of these market makers. They will have a book of stocks that they're prepared to buy and sell. They literally run a book, a bit like a second-hand car dealer, you presume, has a stock of cars. They buy at one price and they sell at another price. They buy low, just like second-hand car dealers, and they sell high, because they're trying to make money, all right? And essentially, brokers can put trades through these dealers, if you like, working on behalf of the London Stock Exchange to match trades. Because, you know, from the exchange's point of view, the more deals that get done, the better, okay? Because that obviously means that the reported volume going through the exchange compared to its rivals looks that bit more impressive, all right? So in a nutshell, one of the big jobs the London Stock Exchange, let's say, is to match trades. A lot of them are done electronically, all right, and some are done in a slightly sort of more old-fashioned way, involving market makers. But even where market makers are involved, again, the London Stock Exchange has an electronic system that allows you to place the trade. So in either case, you're not seeing the kind of colourful jackets and shouting of orders that goes on somewhere like the New York Stock Exchange or in Chicago, for example. So just be aware that what I'm describing here isn't universal, insofar as over in America they still agree trades manually, if you like, face-to-face with hand signals and so on. But in Europe, this idea of electronic trading and electronic order matching is becoming more and more prevalent because it's fast, it's cheap, and it's totally anonymous. Okay? In other words, a broker can put an order through this order book without revealing who they are, and that can be useful if you're trying to do a big or slightly awkward trade. Now, just a few words about what else an exchange can offer. Is it just matching trades? Well, no. They can also offer a form of guarantee. So, remember that point I said about what happens if you're worried that whoever your counterparty to the trade is, if you're selling, whoever your buyer is, won't pay you. Obviously, if you're a buyer, the worry is that the seller won't deliver the shares they've just promised to deliver when this deal was done. All right. So to get around that, the London Stock Exchange, like other exchanges, has a relationship with an organisation called LCH ClearNet. Bit of a mouthful, but essentially that contract means there is somebody out there guaranteeing that if the buyer doesn't pay, effectively the exchange or the clearinghouse will, and if the seller doesn't deliver shares having agreed to, then the clearinghouse will. So in other words, you can be confident as someone using the exchange that deals will be honoured. Okay, so the final point is London Stock Exchange has an arrangement to allow for the settlement of shares. I won't go into that in any detail here because we're talking about exchanges, but there is an organisation out there called Euroclear Crest, and in a nutshell, that copes with the final stage of a share transaction, which is the fact that in the UK, shares are registered, like property. Basically, a central electronic register has to be updated when you buy shares and updated when you sell shares, and somebody needs to do that. So to take away all that hassle, the exchange say, well, if you deal through us, that's pretty much automatically taken care of. All right, so all the sort of administration that goes at the end of a share deal, they effectively deal with too. And all of this costs money. So a broker will expect to pay, to use the order book at the exchange, for that guarantee, for the settlement bit, and that of course is why your broker charges you to do a deal. So, you know, a little bit of that $9.99 per trade, whatever you're paying, is going into the broker, paying for all this lot. All right, so let's just summarise why exchanges exist, or 2 or 3 key points, just recap on those, and then I'll talk about the kind of one big current issue that's worrying exchanges at the moment, and then we'll leave it there. Anyone who wants to know more about shares themselves, take a look at 1 or 2 of my other videos, and if you want the background of this whole video, I've done an introduction to financial markets, which covers where this kind of fits in. Okay, so just to wrap up on those final couple of issues. So, in a nutshell, what are things like the London Stock Exchange all about? Well, price transparency. In other words, if I'm planning to buy or sell shares, looking up a price at the London Stock Exchange, by the way, the prices are quoted daily, so the closing price at the exchange around 4:30 in the evening, well, slightly nearer 5 o'clock, being technical about it, is published, so people use that. Fund managers, for example, want to know at the end of the day what the closing price for, say, Tesco or Vodafone was, so they can value their portfolios accordingly. So exchanges are a useful reference point both for the price that people want to do a deal at, and also the price that fund managers and investors will, as they call it, mark their portfolios to market at the end of the day. So lots of price information from exchanges, which is very useful, and also information about how many deals are getting done and all the rest of it. Number two, they can provide the anonymity that some of the bigger players in the market like. All right, now there are other ways to achieve that in practice, but if you don't want to have to go out and find a counterparty over the counter, then exchanges offer you the ability to trade without revealing who you are, and that can be useful. It doesn't matter if you're offloading 5 shares, but if you're offloading 500,000, anonymity is quite important, otherwise people will start to move prices against you. Okay, and that's true in any market, not just for shares. Number 3, the guarantee and settlement arrangements. The guarantee being that if you buy shares through an exchange, basically the deal will be honoured by the seller and vice versa, and settlement being the fact that shares are legally registered in the UK, so there's a bit of administration that goes with them, and an exchange can offer to cope with sort of most of that. Again, most of it's electronic in the UK market these days. So those are 2 or 3 key reasons why exchanges exist, and perhaps going back to the origins of exchanges, when dealing in shares moved out of coffee houses, regulation. In other words, only certain people are allowed to join the London Stock Exchange as members, and that hopefully imposes a degree of sort of regulation on the market. It makes it less likely that people will fail trades and so on. And failed trades, when trades were done in coffee houses informally, were a big feature of the market, and one that exchanges tried to kind of eliminate. Okay, so that gives you a flavour for the main reasons, or some of the main reasons, why exchanges exist. And of course we've got exchanges all over the world now. You've got them in New York, Chicago. Some of them are stock exchanges. Some of them are more sort of derivatives focused. I've done some videos on derivatives for those people interested. Some of them focus on commodities, the exchanges in Chicago, for example. And some markets don't really have an exchange, or it's not an obvious big exchange. For example, in the foreign exchange market, traders are quite happily to do deals over the counter most of the time. So in London, for example, it's quite hard to find, to put it mildly, a foreign exchange, all right, where you will find a London Stock Exchange. Okay, so these things have sprung up basically as demand has dictated. Now, just to close out, what's the big issue in the headlines around exchanges? Well, there are several. Exchanges like to advertise themselves as being fast, cost efficient, offering a massive range of services. The London Stock Exchange will say, come to us because we offer a low cost electronic dealing platform, okay, and that's attractive to members of the exchange, for example. And we also offer a wide range of different securities through the exchange for trading. And there's one of the big issues. Exchanges are under increasing pressure to consolidate, to merge and become one-stop shops. That's a buzzword you'll hear at the moment. In other words, the London Stock Exchange can't just sit there, okay, complacently offering a sort of list of liquid UK stocks. People want to go there and buy international stocks. Maybe they want derivatives, maybe they want commodities. Okay, so increasingly exchanges are merging and getting together to provide that kind of one-stop shop, and also drive down costs. Big is generally thought to be beautiful. So in the UK market, for example, we no longer have regional exchanges in Birmingham and Manchester and so on. Years ago they all got squished into one sort of London Stock Exchange, and now internationally there's pressure even on those domestic exchanges, the dominant ones, to get their act together, get even cheaper, move further towards electronic trading and offer a bigger and wider range of securities to their members. And that's something you will see plenty of commentary on in the press at the moment.